First of all, thank you everyone for joining us today. Today is Wednesday, November 16th, 2022. I know as you guys were coming in, I see a lot of familiar names as you all join. I know I haven't met everyone yet. I met some of you last quarter on the webinar and then some of you in the office for your review. If we haven't met yet though, I'm Karina Olson and I joined the team as an advisor in May. And then of course, today we have David and Jake joining us, who you all probably know. You'll notice Eric and Linda are missing today. We did give them a day off from presenting, but don't worry, we did make them still join us as attendees. So for today, we do have about 35 minutes of remarks prepared for you. And then we did set aside some time at the end for Q&A. Couple housekeeping items though before I dive into all of this. So as always, everyone's going to be on mute throughout the presentation. So we do still encourage you to ask questions. At the bottom of your screen, there should be a Q&A feature. You can go ahead and use that, ask throughout, but we'll probably save them till the end. The webinar is going to be recorded, so that way we can go ahead and post this to our website in the coming days. And then we'll also make the slides available. So everything we're covering today, if you do want a copy of it, just reach out to us, give us a call, send us an email, and we'll go ahead and send that your way. So with that, all the housekeeping's done. So let's go ahead and go over the agenda. Okay, so what we're going to go through today. So we've titled most of the webinars this year, Transition 2022. Last quarter, we really talked about what's changed over the year. We're going to continue that conversation today, but we're also going to discuss how long we think this will last. David's going to then take us through the economy and interest rates, and Jake's going to discuss the markets and what we're doing in the portfolios here at Copperwind. I'll then wrap us up with the financial planning tip at the end before we dive into that Q&A. So with that, David, go ahead and kick us off.
Great. Thank you, Karina. Welcome, everybody. It's good to be talking with you here today. What I'd like to do is go back sort of our, go back machine to the first quarter. And when we started the year, we said there's really three paths that we see, an optimistic case, a base case, and a worst case. And a lot of it depended upon what the Fed was doing and geopolitical events and corporations and stuff. Unfortunately, we're more on the worst case scenario here than we were thinking base case. So when we go up to the third quarter, our last webinar that we had, here's what we sort of looked at. We said, yeah, we are in a bear market. The market was down 20%. The S&P, if you look at the NASDAQ, it was down 30%, and bonds were down 15%. It was a question of is the Fed raising rates too much or not at that point? And clearly the Russia-Ukraine thing had gotten a lot worse than when we were talking in the first quarter. At the time, we were looking and saying, is the Fed becoming a headwind to the market? Because the economy was still doing quite well. We'd seen some supply chain issues that had eased. And inflation, it was moderating in some areas, but we were saying consumers and corporations are still really strong, and volatility was going back more to normal. Well, we fast forward to today, and some of those have changed a little bit. Valuation correction in stocks where they're going down because price to earnings ratio is going down continues. It's still a question whether the Fed is raising rates too fast. One of the things that really is a concern for us right now is the corporations and consumers are not quite as healthy and strong as they were a couple of months ago or back, especially in the spring. And normal volatility, it's jumped up quite a bit here lately. So when we look at where we are, probably a little worse definitely worse than it was when we were talking the first quarter. From the third quarter, maybe a little worse in some of the consumers and corporations. We're going to talk a little bit about that. So let's jump directly into the current economy. When you look at GDP, we had 2 quarters that were negative. And as you remember, we said, the first quarter was negative, but is really more of a math problem of a big surge in imports that knocked that number down. But generally, everything was still positive in the first quarter. Second quarter, it was really more of a slowdown. The third quarter's rebounded, but part of that is the math numbers from the first quarter coming back in on the third quarter. So it was positive. I don't think we're in a recession, but it's not as robust as we would hope it would be. And for the fourth quarter, the numbers are probably still going to be positive, but there's a lot more question marks than we've seen in the last 6 months. Now, if you remember, everything's been driven here by the Fed, and what are they trying to do? One of the things we talked about is them trying to slow down house price appreciation. You're starting to see it on the existing home sales. This is home sales by month. And if you look from the first of the year, we're down 27%. Now, why is that occurring? It's pretty easy to see. If you look at the box, this is mortgage rates, 30-year fixed. They've gone from 3.2 to nearly 7%. In fact, last week or week before last, they were above 7%. Yeah. And that's a killer if you're buying a house now and financing it, because prior to this, if you got a 3% mortgage and had a $600,000 3% rate on your mortgage and $600,000 mortgage, to get that same payment, you need to only have a $450,000 mortgage at a 6.9% rate. So clearly prices, there's pressure on being able to buy houses and the prices of them. So if we look at the next slide about the house prices, they've topped out, they've rolled over, they're coming down some, not dramatically yet. But what you typically have is a paralysis at the top of the market, because I saw my neighbor's house sell for $600,000 and mine's nicer than his, so I'm not going to sell it for less. And when the offers come in less, I reject them initially until somebody in the neighborhood sells theirs for $550, and that's the new comparable, and I have to lower my prices. And I think you'll see that, but it may take another 6 to 12 months. You are starting to see, prices being dropped, not materially. I just went on Zillow the other day and looked at a half a dozen houses in the valley, and half of them had reductions, but it was 5,000, 10,000, 15,000. It's not 50,000 or anything like that.
And Dave, this just shows up until August, right? So
correct.
It's only like a 2.5% drop. Obviously, we've seen a little bit further deterioration from there, right?
Yep. And now one of the things you're seeing by the builders, where it won't show up in the house prices, but it really is a drop, is where they're buying down the mortgage rates. And that may be 2 to 5% of the purchase price or the mortgage value that they're doing. It still shows that they're paying $600,000, but the reality is, that on a $500,000 mortgage, they paid 5 points down, so they paid $25,000. So it was really a $575,000, not a $600,000. So those types of games are going to be played, I think, a lot, just to and that will distort that. But you're clearly seeing that if you go more over into the general economy, this is they call it the ISM manufacturing PMI, and the PMI is Purchasing Managers Index. And it basically in manufacturing goes to manufacturing companies and says, what do your new orders look like? What are your prices? What are your shipped orders? What's your labor costs? All of those things. And anything above a reading of 50 is I'm expanding. Below that, I'm contracting. Well, what you saw is, in 2020, of course, it plummeted down, but in 2021, it got, quite high. And now, since the first of the year, you're down about 15%. You're still positive. 50.2 is still positive, but it slowed down because everybody was buying stuff. Now you fast forward that to the next slide and say, what about on the servicer side, on the services side? That's, going out and doing things, not purchasing things, but doing things. And what you saw is we were, at the end of last year, we were at ridiculous numbers, nearly 70 on that. At the first of the year, you were at 62.3, and you've had a 13% decline. But 54.4 is still pretty good because people are still wanting to go out and do things. If you jumped on a plane anytime in the last 6 months, it's apparent that everybody wants to travel. Interesting enough, yesterday, Disneyland and Disney World, they announced significant increases in their park prices. And
every year.
Another increase.
And because people are paying it. So anyway, you're seeing those coming down. So things are slowing down, but they're still positive. If you look now at what's driving the real estate market down, where we were talking about that, you're going to have some slowing on the jobs from not as many houses being built. But this on the labor markets, when you look at it, we've seen a strong labor number. Last month, it was 260,000 new jobs. You annualize that, that's 3 million jobs a year. That's a huge number. But why we bring this up is when they do those surveys, they do two surveys. The first is the establishment survey. They call tens of thousands of businesses, ask how many people did you hire, how many did you fire, what were your wages, those types of things. They also ask tens of thousands of households. That's why they call it the household survey. They say, are you working? Are you working full-time, part-time? Are you looking for a job? Are you unemployed? All those things. And if you go back to August of last year and look at that, the green line or the red line, one will be above the other, one will be below the other. But most of the time they cancel each other out over time. Since March, there's been a disconnect. When you look at the establishment survey, they're showing 2.3 million jobs added compared to the household survey. That's nearly unprecedented. You've had some deviations at times, nearly unprecedented. Somebody's wrong, and I suspect the wrong side here is probably more on the establishment survey. I suspect that there's probably not as many jobs being created, but time will tell. But if you look at the household survey on the next chart, March to October, you saw a minus 490,000 of full-time jobs, so a reduction by 490,000, but then 492,000 of part-time jobs created. Well, those are not equal. One's full-time, one's part-time. So you'd nearly need to just be flat. You'd nearly need double that 490,000 to get to equal if you're doing part-time jobs. And a lot of times part-time jobs also don't have the benefit. So it's not as lucrative also. So there's some problems in the labor market numbers that I'm sure, in the next 6 to 12 months, we'll figure out who was right and who was wrong. But if you look back in the first quarter, there were hardly any layoffs. And you can see it here. These are announced tech layoff tech companies laying off people that are announced by month. What you've seen is since June, they've jumped up. You're also seeing in November, you had Tesla, you had Amazon, you had FedEx. You're having lots of companies. Facebook, yep, they had some
Twitter again.
Yep. So you're seeing this, and that's now tech ramped up and has come down a lot, but you're seeing it across the board. For example, Target announced today earnings were not what they expected, dropped 15% today. And they did say that the consumer is struggling. Interesting enough, Walmart had announced when their earnings were actually better than people thought, but they said they were getting more on the grocery side and less on the non-grocery side as far as revenue, which was surprising until you start thinking about it. If people start to get concerned about spending money, they may go from a grocery store, an Albertson or Safeway, and they go to Walmart because it's cheaper for groceries. So that's telling you a little bit. TJ Maxx, they came out, beat their numbers, and they're people going from, I'm going to go from the name brand to a discounted name brand. So I think you're seeing some of that, and that's indicative that the consumer is not in as good a shape as they've been in the past. So if we now look at what does that translate to on the unemployment rate's still really low. I mean, that's at 3.5 to 3.7 is 50-year low. So when people look and say, well, yeah, but you said there was a problem in the reporting. Well, this number is coming off the household survey, not the one that is more projecting more jobs. So if we go into a recession, which we think we will sometime in the next 6 to 12 months, it will probably be shallower, dramatically shallower, I think, than 2008 and 9, simply because the banks are in good shape and we're starting from 3.5, 3.7 level. So You are seeing, a little weakness in some of the stuff in labor, but it's still fairly healthy. If we take that and then say, we talked about inflation, and that's why Fed's raising rates, because of inflation. We talked about it. If you remember at the first of the year, we said, oh man, it's ridiculous how used car prices have gone up so dramatically in the pandemic. Well, they're starting to come down. You even just going to new dealerships, you're seeing more cars on their lots today. And so those are coming down. And I will tell you that is a problem for car leasing companies and banks that have loaned on autos, because the last couple of years, they didn't have any losses because, if you defaulted on your loan and they repossessed it, they could sell it for more than was owed against it. That's going to turn around. But the shelter piece is going to be more consistent, more persistent. And that's because it's over 30% of the CPI number. And the reported number last year was like 4.7, 4.9%. Well, everybody knows shelter costs, your housing costs went up more than that. And so we're going to have a catch up over the next 12 to 24 months. And that's going to keep the CPI number higher. The Fed is trying to get the CPI number down to basically 2 to 3% by a year from now, end of next year. I think there's nearly zero chance of that. I think it'll take them at least 2 years. Doesn't mean that the economy can't continue to grow during that time frame, but I think it's going to take them longer than they think.
But it definitely feels like inflation has at least peaked in the short term, right? I mean, you've seen the CPI numbers for the last several months been trending lower, not by that much, right?
Yeah, no, and you're exactly right. And the PPI numbers have been good. The producer, the inputs to manufacturers, those numbers have also been good. And those flow through, of course, ultimately to the CPI numbers. So I think you're right. It looks like we have seen the peak, but I think it's just going to take longer to get down. And the reality is the Fed screwed up last year. They should have been raising rates a year ago in the summer. And they were saying, oh, it's transitory, it's going to be fine. And it wasn't. And now they're playing catch up. And does that impact how things ultimately turn out? Maybe, maybe not. We'll see. But let's go over to the Fed and the numbers on the Fed. So if we look at this, they started the year and they started with a 25 basis point, quarter point raise, and then a 50 basis point, and then a 3/4. And this stair step, and what we were going to do, if you look at the subtitle, Stairway to Recession, it was sort of play on Stairway to Heaven, and we had it embedded, and Jake didn't want to sing Stairway to Heaven. But
imagine how bad that would be if I started singing.
So anyway, I do think this will ultimately push us into recession. And now what you're looking at is a 5.2% terminal rate, probably sometime next year. Why did the market sell off in the last couple of months, really since August or September? Is because the July projections of these terminal rates were that we would be at 3.6, 3.7%. And what the market doesn't like is surprises, and that's what has been. And we talked about it the last time. We talked about it saying, look, the market is saying here, the Fed's saying it's up here. Somebody's got it wrong, and the Fed came out and said, "Look, we haven't changed. We were saying we're going to continue to raise rates into next year." You're starting to see that people are again saying, "Oh, the Fed's going to blink. They're going to start lowering rates next year." We may have another rude awakening, but you are having a few of the Fed officials that are saying, "Hey, things may be a little bit." Give us some wiggle room of not raising as fast, but I don't think they're going to turn around and lower rates next year. So I think from that perspective, you got to look and say, we're going to have some more pain here, and that's going to have some implications. One of the implications is we've gone from 10 trillion debt in 2008 to 31 trillion in debt, and for most of that time had ridiculously low rates that allowed politicians to borrow money and not cost them anything. That's going to change. We're going to see one of the largest increases in interest expense over the next few years that we've ever seen. And, there's a cost to pay. I mean, you can't have zero interest rates forever. I will tell you the one benefit that we're going to see and you're going to see in your portfolios is that rates, which 2 years ago, if you go to the next slide there, were at 0 and some fairly low rates on high yield and bank loans and preferreds. If you fast forward to today, the orange bars are where they are today, and they've come up dramatically. As we're sitting in some of the on some of our bond positions that we've exited, we're sitting in treasury bills that are yielding us 3.5%, 4%. A year ago, they were at 0. So it used to be, if we're out of bonds, we're making nothing. Now we're making something. And Jake will get into how we manage that quite well this year. But one of the things that I'm looking at when I see like the senior bank loans that Jake has highlighted there, we just got into one of those funds this week that's yielding over 7%, and at the first of the year was less than half of that. And we also got into a high yield bond fund that was probably 4.5. That's now over 6. So ultimately, that's going to get some real good opportunities over the next 12 months to get in at substantially higher rates than we've been able to have for 10 or 12 years. So yes, there's some downside if you're looking to sell your house or buy another house right now. It's not going to be as good as it has been. Federal government's going to have to pay money for their debt, but you're going to be able to earn more money on some of interest that you're going to earn in the low risk pieces of your portfolio. So let me turn over the market commentary and what we're seeing there and what we're doing in the portfolios to Jake.
Yeah, I thought that was a good summary, Dave, of the economy, some of the good and the bad that we're seeing, right? But from a market standpoint, it's not surprising. The market's just been volatile all year. I mean, I kind of liken it to a storm. It seems like from day one, it's just been a storm all year, right? It's been raining.
Yeah.
And anytime I get a chance to give a hiking analogy, I'm going to take it. So let me tell you what that reminds me of. So when I was a scout leader, I took some young men up to Kings Peak, which is the highest peak in Utah, about 13,500 feet, right? And beautiful day, we get hiking up there. There's not very many clouds in the sky. We get to the top, get to see the views. Everything looks good, except for when you hike, one of the things you always look for is what's the weather like, right? And here in Utah, most storms come from the west and they move to the east. But when you're in the high Uintas, they can come from anywhere. And so as we get to the top, we look out to the northeast and there's kind of a dark cloud, looks kind of threatening, and it starts to kind of move towards us. So we're like, okay, it's time to go. We start to head down. By the time we get to the saddle, this storm cloud's right on top of us. And, we get hail, a bunch of rain, thunder, lightning. So we're kind of booking it down to the valley, right? And this trail is just a river of hail. But we get to the bottom and find some big rocks to kind of find shelter in. And that's our protection. And as we kind of weather out the storm, right? And this year, it's really felt like there hasn't been many places to go for a safe haven. And typically bonds have been that safe haven. That's the protection that most people rely on within their portfolio. And I think we used this graphic last webinar, but just updated now. But over the last 8 times that the stock market has been down in a calendar year, bonds typically have risen. It's been different this year. Both stocks and bonds are down, and they're down pretty big, double digits. And the biggest reason why we've seen bonds be down so much is just because of what David described as this sharp rise and quick rise in rates. And the difference between previous years when bonds have gone down is bonds historically have had a buffer because of the yield that they have. They're usually yielding something. Well, last year, bonds had no yield, and so it was basically all risk and no return. And so that's been the primary reason why we've seen that. And ever since I've known David, he's been talking about this. He's like, there's going to come a time when Treasury investors wake up in the morning and realize they're down double digits or lost a lot of money, and they're going to say, how did I lose money in a risk-free investment? Or the conservative, individual that's mostly in bonds wake up and, they're down 10 to 20%. And I would say, Dave, this is the year that you've been talking about for many years.
Yeah,
So-
well, a broken clock isn't right twice a day, right?
So obviously it's been tough. The good news is our bond strategy that we run, we call it total return, has mostly avoided this storm in the bond world. And that's been a real benefit to our clients this year in their portfolios. And it's not our entire portfolio, but as we talk about the bond side, it's been a real home run this year. And the main reason we've been able to do as well as we have is because we've avoided being in some of the bonds. We've stepped out and moved to the sidelines. And so we thought this might be helpful for people to see is what does that look like through the year? And this is just each of the months, it's at the end of the month, and it's just representing what percentage of money markets and treasuries have we been in. So you can see our bond portfolio in February and March was 100% out of the market in money markets and T-bills. And in fact, that's happened 6 of these 10 months. We're largely out of the market. Several of the months we've been partially in, and this has been the main reason that we've been able to avoid this year in the bond world. But that's the beauty of this strategy that we run, and the reasons why we like it so much is it avoids some of these big declines. We saw it in 2020. We saw it in 2018. We saw it in 2015. This portfolio does a good job of avoiding these declines. And so what that's meant for your portfolios over the past 5 years, this is just showing risk and return. So return is here on the left. So the higher you are, the better. And risk, the further you are to the right, the more risky you are. And this is measured by standard deviation. But what you'll see is we've just highlighted some of the things we like to invest in. So here's bank loans, here's junk bonds, preferred stocks, high yield munis, and emerging market bonds. And then we also compare it to the aggregate bond index, which is really a broad basket of investment grade bonds. And so here's been our return within this bond strategy, this total return, is we've been able to produce better returns with a lot less risk. And the main reason we've been able to do that is avoiding these big declines. And
Jake, in looking at that, we've been more out of the market this year on the bond side than any other time. We've been running this strategy for 12, 13 years, more than we've ever been before. And that's what saved our bacon here. That's the rocks that you crawled under at the bottom of the hill. So.
Yeah. Oh, that's a good point. Because last year we were mostly in the market, right? I mean, had to make very few changes through the year, and this year we've had to make a lot more. So I think that's helpful to kind of look at from what we're doing on the bond side. David kind of mentioned this a little bit. We have allocated a little bit back into junk bonds. We've allocated a little bit back into bank loans. We'll see how long we're able to stay in those, but at the moment we'll continue to kind of allow this model to help dictate when we're in and when we're out. As we turn to stocks, one of the things that we've talked about a lot this year has been valuations. And we've talked about it really for the past 5 years. Is things have been kind of frothy. I mean, valuations have been on the extreme. Last year felt a lot like 2000, where you had many companies that have, many growth companies in particular that were just had crazy valuations, and they didn't really have many earnings. And this year, David kind of mentioned to it or alluded to it, just corporate earnings have actually been surprisingly pretty good this year. What happens though is analysts, they forecast future years. And so we've talked about 2023 earnings being way above where we thought they should be. And typically as analysts do these forecasts, they usually forecast a high number, and then as it gets closer to the year, they get revised down. And so you can see this within this chart. This dotted line is the average revisions down on their forecasts. And typically it's anywhere between 5 and 10%. And then this range is just showing you, one standard deviation above that average, one below. And so what we've seen this year is the 2023 forecasts have been getting cut a lot quicker than normal. And we're not surprised by that given where they were. But there's been some good earnings. I would say, energy companies have been very strong. You've seen some of the, value companies like a Coca-Cola, David mentioned Walmart. Those have actually held up pretty well. But the tech earnings have been bad, and the forward guidance that they provided has not been very good. So one of the things we like to do is look kind of under the hood of the market and what's going on. And so when we look at, one of the things we look at in the markets is dispersion. And dispersion is just what's the range of returns from like the spread between the best performer and the worst performer. So the market this year is down roughly 15%. Energy has been the standout. It's up a lot, 70% this year, but everything else has been negative. So there really hasn't been a place to hide. A lot of the growth names and tech names that did really well last year are among these bad performing sectors. And some of the value stuff has done a little bit better. And so how does that translate into what we're doing? So as you know, we run lots of different stock strategies. They all have their pros and cons to them. But what we try to do is build these, we take these strategies and put them together within a portfolio. And one of the strategies that I think is worth highlighting here has been our 50 stock value strategy. Most indexes like the S&P 500 is a market cap weighted index, meaning it puts more weight to some of the bigger companies. One of the things we do within the 50 stock value strategies, we take a more sector neutral approach. And that's been helpful this year to, and it's allowed us to do a little bit better than the market, and quite better. But some of the big names within that strategy are some of these energy names. You got ConocoPhillips, Valero, Chevron's in there. Those have been some of the standouts this year within that strategy. The other place that I think is worth talking about when we talk about dispersion is what we call the US style box. So every stock that you look at falls within one of these categories. It's either a value company, so think like Bank of America or Berkshire Hathaway or Walmart, or a growth company like an Apple or a Google or a Facebook. And then what you see on this side is really the size of the company. Are they a large company, mid, or small? And so this year, it hasn't mattered so much about what size of company you've been in. It's mattered more about the style that you've been in. So growth has severely underperformed value. And as it relates to our portfolios, we've kind of seen the same thing. Some of the growth strategies that have done really well in years past are some of the laggards this year. And then our value strategies, kind of like that 50 stock value or dividend value, those have been some of the better ones that have performed this year. And we also have some strategies that kind of are dynamic, meaning they'll move between the different areas. And let me give you an example of that. So one of the pieces that we run is a momentum strategy, and momentum, it tends to just go to the place that's doing the best, right? And what we saw at the beginning of the year is we were much more on the growth side going into January, and the reason for that is because of how well growth has done over the past 5 to 10 years, and very little in value. And as the market started to deteriorate, what started to happen is it started to shift, where we ended up having more value and less growth. And that's kind of where we stand today. We definitely have a bigger weighting towards the value side than we had going into the beginning of the year. So that's one of the strategies that is dynamic and has been able to benefit from that dispersion of return. So with that being said, I think as a summary, as I mentioned, our growth strategies have lagged a bit. Our value strategies have done well this year. Our total return bond strategy has been a home run. And we continue to feel that we're going to have some volatility going through the rest of the year. And a lot of this is going to be determined by what's happening with the Fed and inflation. So when markets are down, though, we always look for what type of things can we take advantage of. So I'm going to turn the time over to Karina to talk about how we can make some lemonade out of lemons, I guess.
Yep, that's what we like to say. Thanks, Jake. So yeah, one of the questions we've gotten is now a good time to do a Roth conversion because the market's down? Some of you may have heard that and wonder why. It's really because while the market's down, we can move stuff from your IRA into your Roth IRA while it's low, then it's in there. And when we get that rebound, it'll be able to get that tax-free growth in the Roth. Unfortunately, the question isn't as simple as a yes, no for everyone. So we do actually have a tool we like to use to do more of a tax analysis. So I'm going to walk you through an example here. So I would like you to meet Dick and Jane. So Dick and Jane here, they recently turned 65 and retired from their banking careers. Together, they bring in about $75,000 a year through Social Security and a pension. And with this income, they don't need to use their $1 million in assets that they have. So their goal is to be able to pass this down to their children tax efficiently. So they came to us and said, should we do a Roth conversion? So what we want to do then is look at their entire tax picture. Some of you have probably already seen the software that we use. It's fairly new that we've been doing. And what it is we're able to create a tax pro forma based off of your prior year returns and this year's info. When I say we, though, I do need to make sure I let everyone know it's really Javi and Myra, our paraplanners, who are putting all this info in for us. So thank you both for doing that. And then we're able to pull this up and look at a couple different things. One of the things you'll see kind of starting just working our way down, we're able to look at how much of the Social Security is taxable. Right now, about half of their Social Security is taxable. We're able to then look at what is the adjusted gross income or the AGI. And then on the right side, it tells us what marginal bracket are they going to be in. So they're in the 12% bracket. And then ultimately, how much can they expect to pay in taxes? And right now it's about $3,000. So they want to know, does a Roth conversion make sense? So once we get this, we're able to produce this chart here. And I know this is a lot of different colors, a lot of different info on the screen. Before I break it down though, then one thing that's really nice is just right up in the top right, it tells us right away that they have $27,000 until they jump into the next marginal tax rate there, which is awesome. But looking deeper at this, there's other things that we actually want to go through. So over on the left, you'll see the tax rates going up from 0 to 25. And then along the bottom, you're going to see the different income levels and as it goes up there. So what we're looking at with the purple there is Social Security. I mentioned right now that they're being 50% is being taxed. So you'll see as that increases. The red is the capital gains taxes. And then that dotted line, it's a little hard to see, but Jake's pointing to it right now for us. That's actually where the Medicare premiums increase. So this lets us know that there is some room to do that Roth conversion. So what we can do is we can actually plug that in and run a different scenario and compare them. So we can create another pro forma. If Jake, you want to click to the next slide there, perfect. So now you'll be able to see we have two situations, the original one on the left and then one with a Roth conversion. If we were to do a $25,000 Roth conversion, how does that impact their taxes? Like we already knew because of that chart, really helpful, we know they're going to be taxed more in their Social Security. We also know their AGI is going to increase because of the Social Security, and that conversion does count as that income as well. But what's nice over on the right is we were able to do amount that kept them in that same marginal bracket. And we're able to see how does this really impact the total taxes, and it increases it by about $5,000. So in this situation for them, paying a little more in taxes now for that $5,000 to be able to get that rebound, have that tax-free long-term growth to be able to pass it down makes a lot of sense. So we'd probably go ahead and do that Roth conversion. Now, every situation, as you can see, is different. There's a lot of different things that this tool can do. So we can look at Roth conversions, we can look at QCDs, charitable gifting, Charitable lumping, I know, is a big one we talk about as well. And even just the tax loss harvesting, looking at realized gains versus losses. So something that we recommend this time of year, if you want to go ahead and do a tax analysis with us, I know it's one of Jake's favorite topics, so he'd be more than happy to help you out with this. But we'd be happy to meet with you and kind of go through this and see if it makes sense for your situation. So that's our quick financial planning tip. Before we head into the Q&A though, I am going to head it back to Jake here to kind of wrap it up for us and let us know what else we're looking at as we go into 2023.
Yeah, it's really good, Karina. Thanks for kind of walking us through that. I love tax planning just because I've seen it just adds a lot of value to our clients' situations. So I can't, this is the time of year to do it. So yeah, let's just, from a summary standpoint, we talked about a lot of stuff, but these are some of the things that continue to be on our radar. I would say the two biggest are inflation and the Fed. What's happening with inflation and what the Fed is going to do about it. They've continued to be raising rates, but they're also tightening in other ways, like having their bonds roll off their balance sheet. So we've seen their balance sheet being reduced. The other thing, continues to be GDP and corporate earnings. We talked about valuations quite a bit. And then lastly, geopolitical events. I mean, Russia-Ukraine war really hasn't gotten any better. I would say there has been a little bit of improvement on the China front, just as far as them reopening and maybe relaxing some of their, or at least hoping that they're going to relax some of their COVID policies. So we're seeing a little bit of improvement there. So those are some things that we're keeping our eye on, and I think this is just a good segue into Q&A. I think we had a couple of questions that came up.
Yeah, Jake, I guess I would add that when I look at overall, I think we're cautious because of what we thought at the first of the year and how some things have deteriorated, but not panicky or anything else. I mean, if you come to resolution in the Ukraine or inflation does come down as fast as they hope it will, I mean, you can see the market rally quite dramatically. And there's some opportunities like we were talking about on the income side that are shaping up to be some real good opportunities.
Yeah.
So Karina, questions?
Yep. So I know we got a question there. You kind of answered it, but I'd like to hear a little bit more about it. So does a recession next year automatically mean a poor stock market in all sectors? And I'll kind of add to that too, if you can elaborate, David. So where do you see these investment opportunities in 2023?
Well, I think when you look at it, I don't see us avoiding a recession at all. I mean, but I do think, given where we're starting at the low levels of unemployment, at the high levels of savings, and people that have locked in, a 30-year mortgage at 2.5% or 3%, mortgage rates go to 7%. If they're not selling their house, they've got this low cost for the next 30 years. So there's some real stability there. Is it going to cause the market to, crater? The reality is the market is forward looking. And most of the time in the past, the market starts up long before you're out of the recession. So that's the challenge that we have. And we saw it in the last 10 days. I mean, the market jumped up, 10, 12%, 4, 5, what was it on the NASDAQ, 7% in one day, on a 0.2% better CPI number. I mean, so I think there will be opportunities on some areas. I do think Jake's thing is the dispersion of returns. I think it is going to work that now it's going to matter what companies you're in. Over the last decade, if you were in the tech sector, even if you were in a lousy company, you made money. I don't think that's going to be the case going forward. So I think picking the right companies is going to be important. And I think you're going to see the best companies are going to rise to the top and the others are not.
I would also, maybe to go along with what you just said, is how markets are forward looking. I mean, not only are they forward looking on the stock side, but also on the bond side. I mean, How many times this year have we talked about, hey, the Fed's going to raise rates, and we have a discussion about treasuries, and they say, well, once they raise rates, I want to then get into that treasury. And the markets have already priced that in, right? Yep. It's more about what's the expectations going forward that are going to have to change for, rates to go up further. So.
Yep, no, absolutely. And I do think on the bond side, some real opportunities that we'll see both in the shorter term stuff of treasuries, that treasury bills that we've seen, that have been at zero for a decade, all the way up to high yield and preferreds and stuff that may be in the high single digits.
Well, thank you both for that. So going to change the topic a little bit, but I know this is one that's been all over the headlines, especially with the election last week. But with Democrats having the presidency and the Senate and the Republicans having the House, how is this going to affect the market? And Jake, I'll pass that one to you.
Yeah, well, historically, markets have liked split governments, and it appears that's what we'll have here. I would say this too, is prior to elections or any of these big events, volatility tends to go up. And then once whatever happens, volatility comes back down. Historically, and we alluded to this in the latest newsletter that we did, is historically markets tend to do pretty well in after really the third year of the term of the presidency. So after midterms. So we'll see if that has any weight this next year. But I would continue to say that although politics certainly matter, right now the market seems to be driven more by the Fed and by inflation than anything. So.
Awesome. Thanks for adding some commentary to that. And also going to your newsletter there, if everyone hasn't read it, I know there's some nice charts in there showing that. So kind of sticking to that, I know the other thing that's kind of worrisome with this split is the debt ceiling right now, right? So with the debt ceiling needing to be raised next year, do we think the US will get close to defaulting like in 2011, given Congress is divided?
Yeah, well, there's been a lot of talk about them trying to get the debt ceiling, done before the end of the year, right? We'll see if they're able to push that and make that happen. It's always a risk, right? Is if it doesn't, and that seems to be one of the things that Republicans are going to try to use to try to get some concessions and maybe bring down some of the spending, but we'll see.
But the reality is, and this is what always bothers me, every time you get, we're going to shut down the government, or we're not going to do the debt ceiling stuff, we're not going to default on our debt. I mean, we can print the money if we need to, but it's always this political stuff, and whether it's the Democrats or the Republicans, they always use this stuff. And just get into the governing and quit playing games. But none of them on either side of the aisle tend to think that way. But it will get passed whether we get to the 2011. But since 2011, S&P's rated us AA+, and that doesn't seem to have bothered us. Adding $20 trillion of the national debt. So I doubt if it will affect us.
Yeah, good insight there. So we probably have time for about one more question here before we wrap up. So David, I'm going to pass this one to you. It's the other big headline we've been seeing all week. So what are your thoughts on the FTX meltdown, and just, is this the end of crypto? How's it going to impact us and the markets?
So FTX, for those of you who don't know, they were basically like the NASDAQ of cryptocurrency. It's an exchange, a trading house, but where people would custody their crypto assets and could trade them. And they filed for bankruptcy. And we, as if any of you guys have asked us about crypto over the last decade, we have not been a fan. And yet, if you would have bought into crypto 10 years ago, you would have made a lot of money. And especially if you cashed it out when Bitcoin was at 69,000, in the last year, not when it's at 15,000, where it was in the last week. But regardless, when we look at it, it's evaporated trillions of dollars in that space, and that does have an impact on the markets. If you had some money in crypto and it used to be worth $1 million and now it's gone poof, and some of them have gone to zero, you feel less wealthy because you are less wealthy. Now, the fact that it might have been made out of just speculation doesn't really matter. You had that money and now you don't. It looks like what occurred there is they had a trading arm and they took some of the customer money and moved it to the trading arm to cover margin calls, and it blew up. And there'll probably be some people that go to jail, probably not the right people, but there's always, we got to find somebody to throw in jail. And usually it was the lower level people that, followed the, orders of the boss, and they're going to go to jail. But it does, and when people say, well, crypto is just another asset, just like a stock or a bond, you don't hear every year several $1 billion just going poof out of people's accounts where somebody stole it. You don't. And that's the problem. In crypto, they say, oh, we don't want to be regulated. Well, if you're not regulated, then you've got a whole lot more risk, and things like this occur. I think this will potentially not be a death knell for crypto, but I think it's going to cause a lot of people to walk back. Sequoia Capital, one of the big, well-known, well-respected venture capital firms out in California, lost $230 million in that deal. They wrote it down to zero. And there were several others that were well respected, and it was the fear of missing out of, well, we have to jump in. And so they put $230 million and it went poof. So I think there's going to be, one is the regulators are going to come in because they're, like I said, there's trillions of dollars in them, billions of multi-billions of dollars that have evaporated or been stolen or gone away or whatever. You're going to see Congress in on it, even though it's based in the Bahamas, and that's where they're doing most of the investigation. They're in 100. There's over 100 entities worldwide that have filed for bankruptcy in this deal. And so you're going to have the FBI, you're going to have the SEC, Futures Commission that's going to be looking at it. Everybody's going to be looking at it. And so hopefully it'll get more regulated so that this doesn't happen again and poof, all your money's gone.
So it doesn't sound like you're a fan of crypto.
I just don't see the concept, because first, where you say it's cryptocurrency, the definition of currency is something that allows you to easily and frictionlessly trade for goods and services at very low transaction costs, and be able to do it across all kinds of goods and services. That doesn't fit crypto. I mean, there's a reason why the SEC has not allowed pure cryptocurrency in mutual fund format or an ETF format, because you cannot quickly move it and say it's completely transparent as far as pricing. So, but the blockchain on which it's built is absolutely a technology that's being used in a lot of areas and will continue to do that. I just have not seen it. Seem like it was more speculation. It's not like I'm lending that to a company that then uses it to grow their business. So,
and yes, I think in the FTX situation, the story's still unfolding, right? It's so new that I'm sure we'll find out a lot more.
But Charlie Munger from Berkshire Hathaway, he said it's, when they asked him about FTX, what caused it, he said, greed, fraud, and delusion. And I stand by his comments.
So I don't think we can end on crypto, Karina. So why don't we end on places that we see opportunity? And maybe that's just investment opportunity.
Yeah. So Jake, why don't you start
into next year? Well, I think we've talked a lot about the bond side. Like, that is one of the places that we see a lot of opportunity. Anytime yields get to where they are, that there's going to be opportunity. And generally, when we have a really bad year in the bond world, oftentimes that's followed by a pretty decent one. So we'll see whether that's in 2023 or maybe a little bit further out. I think the other place that we're keeping a close eye on is international. We've been invested on the US side for so long. that, there's a lot of countries that are a lot cheaper than the US is as it relates to valuations. This has been a year though that international hasn't done all that well, but I would say the driving factor of that has been the dollar. The dollar has been really strong. I think Europe is a good example. The EFA index, it's down about what the S&P is down, but when you look at its local currency, it's down a lot less. We've seen some bright spots in South America as well. So hopefully that continues to build, and if we can get the dollar to come down, I think we'll see some opportunity on the international side. So
no, I agree. In fact, if anybody wants to go to Europe or England, great time to do that. I mean, it's probably 20% cheaper than it was two or 3 years ago. So Linda's going to send me to Europe, but to do some research, I think.
And Jake, you bring up a good point there, and we just got a question then too that we haven't hit on yet with the US dollar. Where do you see that going? What direction? Just given kind of where it's gone this year. I mean, it's what we were just talking about. It's so high right now.
Yeah, I would say this. I mean, the trend has definitely been up, although from a technical standpoint, it's been making some lower lows. If we do get into a much deeper recession, you could continue to see the dollar trend higher. I think as the Fed continues to tighten, and the dollar's been trending very similarly to the Fed funds rate. I mean, it's been going up, and it's been going up strong. So I think that's one place. I mean, but with how much it's gone up and how quickly, it's tough to see it continue at that same trajectory.
Yeah. I mean, because if as the dollar gets stronger, what happens is when we import stuff, it's cheaper, and that helps our inflation. But if I'm an exporter, I hate that, because my product is getting more expensive all the time, and it's going to hurt exporters. It absolutely is going to hurt exporters. And so it's a two-edged sword. But when you say, oh, we want our currency to be weaker, no great country got a lot better as their currency got weaker, because typically it gets weaker when you are a weaker economic power. And you don't see Zimbabwe with very cheap money, as for currency, doing really well. I mean, that's one of the issues. But I do think there's really opportunities, like Jake said, some really cheap price to earnings ratio stocks in emerging markets. I will tell you, the one concern that we have is China, in that Xi Jinping, the premier over there, for his first 5-year term, really for even the first 7 or 8 years, because he's done 2 5-year terms and just got reelected to a third one. He was like, make money, get jobs, and we're going to, allow you to do whatever you, will, as long as you make money and you create jobs. And now he's saying we have to change that, so it's more of a, where it's more of, you've got to be sharing part of your profit and for the good of the country, not just to make money and jobs. And that's a complete change from what he did for what China has been doing for the last 30 years.
Yeah, that's a good point.
And they are the second largest economy in the world. A lot of car companies based in the US and Europe sell more cars in China than they do in their home countries, including the US.
Yeah.
So that's one of the big pieces in the emerging market and international, where you say could be good, could be bad. So
thanks, Jake, for ending us on a different currency note, right? Not quite crypto there, ending with the dollar. So we are just right on time here, and I know a couple people are dropping off, but again, thank you everyone for attending today, and we will have that recording up in the next couple days here.
Okay.
Thank you, guys.